Hello everybody, welcome to ClearHedging and ClearHedging's website. On the website we have some free tools, and today we're going to talk about how to price up put calls, collars on WTI financial swaps. This tool will enable you to save significant money at time of execution on your hedges with your counterparties. ClearHedging provides derivative hedging advice and software risk management tools to the oil and gas sector. This video will focus on one aspect of our free risk management and pricing tool on our website for pricing put calls and collars. Quick disclosure on investment advice and risk. This video is educational only, and tools should be used only as benchmarks and not to be considered investment advice. Trading swaps, futures, and options can create substantial losses. So with that out of the way, I also want to point out that the prices shown in the tools, in our free tools, are not live and are based on previous day's settlements. We do provide live pricing in our tools for those interested, so give us a call if you want to have a demo of our live pricing system. We can be reached either by email or by phone. In the upper right hand corner of our website here, you can see our phone number and our email address. As I pointed out, this powerful tool creates the opportunity for substantial savings. While using this tool, the user gains the ability to negotiate price with their counterparties through price transparency. In other words, with our live version, you can see the same prices your counterparty sees on their systems. With this free version, the data is from the previous night. It differs in that way from our live version, but it can be used as a way to get a ballpark number to negotiate. However, we recommend those looking to negotiate to use our live pricing version. Let's move on to the free tools. Clicking the free tools takes us to our main menu. So let's click on that, and here we are at the main menu. Quickly go through from top to bottom. This is Demo Oil Company, so we have fictitious data in all these functionalities here, and we have it currently in WTI US dollars, which we can change. Date is again January 22nd, 2018, which is the previous day's settlement prices. The button here gives you the ability at the top to pick various products. We are in WTI US dollar. You can also choose Henry Hub, natural gas in US dollars, WTI in Canadian dollars, and AECO natural gas in Canadian dollars. Again, as I mentioned, these are various functionalities and risk management tools that our clients use with their data. Underneath our client login, they're able to log in the cloud and look at all of the features that they have with their actual data. But today we're just going to focus on put calls and collars down here. So let's go directly to that and click on that button. That takes us to a table. Again, starting at the top so we can see what everything is. Settlement date, which is self-explanatory. We've already gone through that. The product, again, that can be changed, and it can be changed with this button over here. But we're not going to change it. We're going to stay at WTI. We could select 1 month. Right here we have 3 months picked, Q2 of 18. We could select and choose and look at, say, for example, April 18, but we're not going to do that. We're just going to go and look at what the rest of these columns are. Across the top is a swap settlement shown here for each month and the average swap for that quarter. We have puts. The put strike happens to be 57. That's populated here, and the put implied volatility for each one of those, and the put price. And down here is the average for that put strip, and the delta and the average delta for that put strip. To the right of that is everything related to calls. So the call here that happens to be populated is 67.76. The implied volatilities here, and the call price and the average of the call price. Let's do all of calendar 18 so you can see how I do that. Click the first month. We're going to pick January of 18. Select the second month, which is going to be December of 18. And here we are, fully populated from January down to December. You can see the swap prices from the marketplace have been populated, and the weighted average of all those swaps. The 57 strike is still populated with their implied volatilities, their prices, the average for the entire calendar 18 strip, and the delta for that strip. The call prices, the call implied volatilities, the call prices, and the average, and the delta. Let's now take a look at how to price up puts. So if we want to change the 57 put to, say, the 55 strike, we'll hit 55 in the white box here where it says put strike, type in 55 and enter, and 55 comes up with the implied volatilities and the new put prices, $1.97. We can change the call strike. Let's make that 75. So we type in 75, we hit enter. and we come up with the call implied volatilities and the call prices and the average price for that. Now, for many of you, you want to be able to price up the zero cost collar. So what we have done here is we've chosen a floor of 55 and the swap price is at 62.09. The zero cost collar would be the call strike that would populate here, where the premium value of the put strip would equal the premium value of the call strip. Now clearly the 30 cents does not match the $1.19, and with a 75 strike, that means because of call pricing, we're going to have to go lower to at the money in order to attain the $1.19 we see over here. We can do many iterations by putting in different prices here in this white box to change the call prices, but we've made it easier where all you have to do is hit this red button and solve for the call strike for the zero cost collar. So if we hit this button, the zero cost collar ends up 67.20, and you can see the premium for the 55 put is $1.19 and the premium for the 67.20 is $1.19. Now for those of you who negotiate with your counterparties on the strike to be sold against a floor, say for example this 55 floor, you might see an offer coming at 66.20, so $1 different. So let's do that. Let's put in a 66.20 and see what that yields us. 66.20 yields us $1.44 versus the $1.19, and that difference is going to be 25 cents. And that 25 cents is a theoretical edge that your counterparty is receiving from that trade. A lot of people confuse and think that because they want $1 lower that the counterparty is receiving an edge of $1. But in reality, what they're receiving is an edge of 25 cents, which is a difference in the premium. It's important to understand that there are many things to be weighed when negotiating price. Liquidity, credit, duration, size of trade, time of trade, is the agreements, whether you have a CSA or a non-CSA, whether you're doing it with an FCM account and using market makers. ClearHedging can explain all these and help guide you through this process. I also wanted to explain a little deeper what I mean by edge. This is not necessarily profit to your counterparty. It's the edge to your counterparty, and it's often mid-market in the marketplace. So depending upon where they're able to hedge the trade and offset their risk will determine whether they're able to capture that 25 cents. So this is not risk-free money. Another button I wanted to point out is the blue button here, Write to Excel. Every table in our system, every chart, has the ability to write their data directly into Excel. So a very useful function at ClearHedging here. The next button is the green button, which is the chart button. I want to explain how this shows us and gives us a good idea of why one might use a collar versus a swap or vice versa. The black line here, as you can see, the prices on the y-axis are the prices of oil, and the dates along the x-axis are the dates that we chose for our strip. And the red line represents our strike that we chose as our floor. And the green line is the solved zero cost collar, or actually the dollar below that we chose below the zero cost collar. Zero cost collar was 67.20. Even at 67.20, if I go back and do the zero cost solve again, I'll do that, and it brings us back to 67.20, and then we go to the chart, you can see that the green line is now 67.20. Still, the distance from the at the money to the call that you have to sell on a zero cost collar to finance your put is significantly smaller than the distance from the swap down to the floor. So on a zero cost collar, you're being cheated a bit by the marketplace, and that's being cheated by the marketplace and not by your counterparty. The marketplace implies using the put call skew, in other words the puts and the calls and how they're valued independently against each other, that determines the skew and determines whether it's beneficial to either do a swap or a collar or other various structures that can be developed around risk. So let's migrate back. Hit the orange button, takes you back, and we can return to our main menu and then to our website. So again, our free tool button and the way to contact us over here on the right. Thank you for listening.